For the last century, the US dollar has been the backbone of global power. It is the most traded currency on Earth, the standard for commodities, the unit in which nations store their wealth, and the foundation of international finance. But behind the appearance of stability lies an uncomfortable truth. No reserve currency in history has ever survived forever. Every dominant currency, from the Roman denarius to the British pound, has eventually collapsed, not because of external enemies, but because of internal decay. Debt, inflation, war, overextension, corruption, and loss of trust. The fall of a reserve currency is not a single event. It is a long, slow, invisible process that speeds up suddenly at the end. People rarely notice the early warning signs, even though they are always the same. Economies become dependent on foreign borrowing. Governments print more money than they can back. Inflation becomes systemic. Military spending grows out of proportion. And trust, the invisible foundation of any currency, erodes quietly until one day it snaps. What makes the dollar unique is not that it is invincible, it's that its collapse would reshape the entire global order. Every country holds dollars. Every major central bank holds US Treasury bonds. Every multinational corporation prices goods in dollars. Every global trade route depends on dollar liquidity. When the dollar weakens, the world shakes. To understand what happens when a reserve currency dies, we must first understand how the dollar became one. In 1944, as World War II neared its end, 44 nations gathered at Bretton Woods in New Hampshire. Europe was destroyed. Asia lay in ruins. The US was the only industrial superpower left standing. American factories were intact. American banks were overflowing with gold. American dominance was absolute. At Bretton Woods, the world agreed to the US proposal. The dollar would be backed by gold, and every other currency would be pegged to the dollar. It was a brilliant move. By linking global currencies to the dollar and the dollar to gold, the United States effectively made itself the center of world finance. Nations needed dollars to trade, to rebuild, to invest. And because they needed dollars, they needed America. For nearly 3 decades, the system worked. But below the surface, pressure was building. The US government began spending more than it earned on the Cold War, on social programs, on the Vietnam War. Dollars flowed out of the country faster than gold flowed in. Foreign nations began to notice that the US was printing more dollars than it could redeem. By the late 1960s, France, Switzerland, and others started demanding physical gold in exchange for their dollar reserves. This was the beginning of the end of the old system. In August 1971, President Richard Nixon made a decision that changed the world. He ended the convertibility of dollars into gold. Overnight, the global economy entered uncharted territory. Currencies floated freely. Money was no longer tied to anything physical. And the dollar remained dominant not because of gold, but because of geopolitical power, military strength, global trade routes, financial networks, and political influence. This is the first lesson of reserve currencies. They live and die not by economic theory, but by power. But power has limits, and over the past 50 years, those limits have begun to show. After 1971, the US faced a problem: how to maintain dollar dominance without gold backing. The solution was oil. In the early 1970s, the US struck a deal with Saudi Arabia. Saudi oil would be priced exclusively in dollars, and the US would protect the kingdom militarily. This created the petrodollar system, a system that forced every nation on Earth to hold dollars in order to buy energy. It expanded US influence far beyond its borders. The more oil the world consumed, the more dollars it needed. And because oil demand grew each decade, dollar demand grew with it. But there was a cost, a hidden one. The petrodollar allowed the US to run enormous deficits, spend trillions on military bases, and consume more goods than it produced. Foreign nations willingly bought American debt because they needed dollar assets. US Treasury bonds, corporate debt, and dollar reserves. This became known as exorbitant privilege, the unique ability of the United States to print the world's currency without facing the consequences that any other nation would face. But privilege breeds overconfidence. By the 2000s, the United States had entered the late stage of every empire. Debt grew faster than GDP, wars multiplied, industries moved overseas, and the financial sector ballooned beyond control. At the same time, a new superpower was rising: China. Unlike the Soviet Union, China built its influence within the dollar system. It became the world's factory, exporting trillions of dollars worth of goods and storing the profits in US bonds. This created a strange symbiosis. The US consumed, China produced, and both were locked inside the same financial ecosystem. But as China grew, so did its ambition. Over time, Beijing no longer wanted to depend on a foreign currency it could not control. It began reducing its US bond holdings, signing oil contracts in yuan, and building alliances across the Middle East, Africa, and Asia. Russia, Iran, Saudi Arabia, Brazil, India, all began exploring alternatives to the dollar. This is the second lesson of reserve currencies. They collapse when trust declines faster than power can compensate. And trust in the US is declining. Not because of one event, but because of a long sequence of decisions. Endless money printing, trillion-dollar deficits, political instability, weakening institutions, sanctions on dozens of countries, weaponization of the financial system, inflation that erodes purchasing power, growing distrust among allies. Every one of these factors weakens the perception of dollar stability. Reserve currencies do not collapse when they become worthless. They collapse when people stop believing they will always be valuable. Today, for the first time since 1945, the world is openly questioning the dollar's future. The signals are everywhere. Central banks buying gold at record levels, new trade blocs forming without the dollar, BRICS expanding into an energy alliance, US debt surpassing $34 trillion, inflation becoming structural, sanctions pushing nations out of the dollar system, geopolitical conflict accelerating de-dollarization. The fall has not begun yet, but the pattern has, and history tells us what comes next. The collapse of a reserve currency happens in 3 stages. 1. Slow decline. People feel something is wrong, but ignore it. 2. Sudden shock. A crisis breaks confidence. 3. Rapid exit. Investors flee, the currency loses dominance, and the world reorganizes. We are currently in stage 1, approaching stage 2. What triggers the second stage is unpredictable. A financial crisis, a geopolitical conflict, a default, a banking collapse, or the emergence of a credible alternative. But once the shock happens, the shift becomes irreversible, and the world after the dollar collapse will look nothing like the world we know. When a reserve currency loses dominance, the collapse is not only economic, it is political, social, and global. Because reserve currencies are not just pieces of paper or digital entries. They are trust systems. They are symbols of stability, power, and influence. When that symbol breaks, everything built on it begins to fracture. To understand the future of the dollar, we must examine what happened when past reserve currencies fell. The Roman denarius collapsed through debasement. The empire reduced the silver content to pay for its expanding army. Inflation eroded trust, trade broke down, and Rome could no longer afford its frontier defenses. The Dutch guilder lost its status in the 1700s as the Netherlands overextended militarily and financially, drowning in war debt. The British pound collapsed after World War II. The empire was exhausted, bankrupt, and forced to hand the global leadership role to the United States. In every case, the pattern was the same: overspending, war, debt, inflation, and loss of global trust. Today, the United States fits that pattern with disturbing accuracy. The dollar remains the dominant currency for now, but its foundations are weakening. US national debt grows faster than the entire economy. Interest payments alone exceed the defense budget. Social divisions are rising. Political polarization makes long-term planning impossible. Infrastructure is aging. Manufacturing has declined. And the financial system itself has become unstable, dependent on constant liquidity injections from the Federal Reserve. The first visible sign of a reserve currency's decline is a shift in global trade patterns. When nations no longer trust the stability of the dominant currency, they begin trading in alternatives. Over the past decade, Russia and China have settled most of their energy trade in yuan or rubles instead of dollars. India buys Russian oil with rupees. Saudi Arabia has hinted at accepting yuan for oil, a move that would have been unthinkable 20 years ago. Even Europe, America's closest ally, is exploring payment systems independent of the dollar to avoid sanctions pressure. The second sign is the diversification of reserves. For decades, central banks held most of their reserves in US dollars. But since 2020, something extraordinary has happened. Central banks are buying record amounts of gold, the highest levels since 1967. China, Poland, Turkey, India, Singapore, all are quietly replacing dollars with physical gold. When central banks start preparing for a post-dollar world, it signals that trust in the dollar's long-term stability is fading. The third sign is the weaponization of the financial system. The US has used its currency dominance to impose sanctions on dozens of nations. Whether the target is Iran, Russia, Venezuela, or even allies, the message is clear. Access to the dollar system is conditional on political alignment. This creates fear, not just among adversaries, but among neutral countries. Nations do not want their economic lifeline controlled by a foreign power. The more the dollar is weaponized, the more the world searches for alternatives. The fourth sign is domestic instability. Reserve currencies require internal strength, trust in institutions, political unity, economic stability, and competent governance. But the United States is facing rising internal division. Elections are contested. Congress is paralyzed. Public trust is collapsing. Inflation reached levels unseen in 40 years. The national debt is so large that it can no longer be reduced, only inflated away. When the world sees internal weakness, the perception of stability erodes. The fifth sign is financial fragility. The US banking system has already shown cracks. Silicon Valley Bank collapsed. Signature Bank collapsed. First Republic collapsed. These failures were not isolated. They were symptoms of a deeper problem: the system's dependence on low interest rates. When interest rates rise, debt becomes toxic. Banks bleed capital. Corporations struggle to refinance. Consumers fall behind on payments. The entire economy becomes more fragile, more vulnerable to shock. This is the environment in which reserve currencies die. Slow decay followed by sudden panic. When the panic begins, it spreads with breathtaking speed. Investors sell dollar-denominated assets. Foreign governments reduce their US Treasury holdings. Corporations switch to other currencies for trade. Oil contracts begin settling in yuan or gold. Suddenly, demand for dollars drops, not slowly, but violently. The dollar falls in value. Import prices rise. Inflation surges. The Federal Reserve prints more money to stabilize markets, but more printing accelerates the collapse. Confidence evaporates. And once confidence is gone, no policy can bring it back. This process would not only affect the United States, it would shake the world. Because the dollar is not merely America's currency, it is global oxygen. US Treasury bonds act as the foundation for global savings, trade, and financial stability. If that foundation cracks, the shockwaves would be global. Banks would lose liquidity. Global trade would slow dramatically. Nations would face currency crises. Markets would crash. Commodities would become volatile. US imports would become unaffordable. Living standards across America would plummet. In such a scenario, the United States would face a crisis unprecedented in its history. a crisis of identity, power, and economic survival. But every collapse also creates a successor. The world would reorganize into a new system, perhaps a multi-currency world, yuan for Asia, euro for Europe, dollar for North America, and gold for global settlement. Perhaps a BRICS-backed commodity currency. Perhaps a return to partial gold backing. Or perhaps digital currencies, central bank digital systems, would replace the old model entirely. The important question is not what comes next. The important question is whether the United States can prevent the fall. History suggests the answer is no. Once an empire enters the final stages of currency decay, unsustainable debt, rising inflation, internal division, declining industry, overextension abroad, loss of trust from allies, the process becomes irreversible. No empire has reversed this trajectory. Not Rome, not Spain, not the Netherlands, not Britain. All believed themselves untouchable. All believed their currency was eternal. All collapsed. The dollar will not vanish overnight, but its dominance will erode year by year, crisis by crisis. And one day, the world will wake up and realize the transition is complete. The fall of a reserve currency is not the end of a nation, but it is the end of an era of global dominance, an era of unmatched privilege, an era of printing wealth without consequence. The United States is entering that final chapter, slowly, quietly, predictably, exactly as every empire before it.